How do we value bonds? Let's review how we determine what a fair price should be for a bond. Okay. So a bond provides interim cash flows, so a set of cash flows in the form of a stream of interest payments, and that's an annuity. It's the same amount over a same time period, and it's a certain number of payments, and also a lump sum at maturity. So a bond contract establishes the amount and the timing of cash flows. Okay? Therefore, a bond's value or market price is calculated as the present value of the coupon payments plus the present value of the lump sum or par value. And remember, the coupon payments are computed by multiplying the coupon rate by the face value, whereas the market rate is used as the discount rate, the IY, to find the present value of the coupon payments and the present value of the par or face value. All right, let's look at a couple of examples of valuing bonds. So let me give you some information about the bonds. The par value is $1,000. The coupon rate is 9%. So what will the coupon payment be? It will be 9% times $1,000. It will be $90 a year. Okay? But it's payable semi-annually, so it will be $90, that's twice a year, divided by 2, $45 per period is the coupon payment. The maturity date is March of 2023, and let's assume that the current date is March of 2013. So it's a 10-year term to maturity. All right, so we'll find the payment, $45, as I said, the coupon rate times the face value divided by 2, $45 is the payment. 10 years till maturity times 2 payments per year is 20, and that's our end. 1,000 is our future value. We're going to get that back at the end. 4.5 is our IY. That's the market rate. The market rate and the coupon rate happen to be the same amount at this point in time. So the market rate divided by 2, 4.5, is your IY. Compute present value, and we get $1,000. And we're going to go over relationships that explain that when the coupon rate and the market rate are the same, then the bond will trade at par value. All right. I already covered that. Since the coupon rate equals the current market rate, the bond will trade at par value. All right. Now assume that interest rates have gone up from 9% to 9.5%. So you issue the bond, it's got a coupon rate of 9%, and the market rate has gone up to 9.5%. Okay? What happens to the market price or the market value of the bonds? Okay. So all we have to change is the market rate. Everything else stays the same, okay, except the market rate has changed. So the market rate goes from 4.5% to 4.75%. All right? So compute present value, and what we see is that the market price of the bond has gone down because the market rate has gone up. Remember that the coupon rate does not change. It is in the contract, but the market rate does go up and down. And so the relationship between the market rate and the coupon rate will determine how the bond is trading. Don't want to get too far ahead of myself. So the rise in market interest rates, this IY right here, has gone up, has made these bonds less attractive. Now you could buy a bond at 4.75% instead of 4.5%. So if you were looking at two bonds and they both had the same price, and one bond paid 4.75% and the other bond paid 4.5%, which bond would you buy? Same risk. I would buy the bond that has the higher payment or the higher rate. Okay? Therefore, something has to give to make this bond that pays 4.5% give you the same return as the new bond that pays 4.75%. And what has to give? The price that you pay goes down. So you'll earn 4.75% on this bond, which would be 9.5% annually. On this, if you paid this price and you got $1,000 back and you got a coupon payment of $45 every period. Okay, so now you would not really care whether you had paid $1,000 for 4.75% bond, or if you paid $968 for the 4.5% bond because you would earn the same return on either bond, okay? So the present value must fall to keep the yield maturity in line with the market. If the market price is less than the par value, so this is less than par value, then the bonds are said to be trading at a discount. Okay, remember, when the discount rate rises, the market rate, the present value falls right here. All right, now assume that interest rates have gone down from 9% to 8.5%. So now you're looking at two bonds. One pays 9%, one pays 8.5%. Which bond would you rather own? Same risk. I'd rather own the 9% bond. What has to happen? Okay? All right, since Facebook issued their bonds, what happens to the market price or value of the bonds? Okay? So the only thing that changes is this. Now instead of 4.5 or 4 3/4, it's 4.25% per period. 8.5% divided by 2. Everything else stays the same, okay, to value this bond. And the interest rate, market rate falls, present value rises, and the present value is higher than the par value or face value, okay? Because these bonds are now more attractive. The 4.5% bonds are more attractive than the 4.25% bonds. So what has to change? The present value, the market price. So if the market rate is 8.5%, if you pay this much for this bond and earn 4.5% on this bond, okay, then you would earn the same rate of return, 4.25%, as you would on the 4.25% bond, the new 4.25% bond. Again, this price goes up, and you would be indifferent between the two bonds. The new bond that trades at 1,000 and has an 8.5% return, and the old bond that pays a 9% coupon rate that you pay $1,033 on it, you would earn 8.5% on that bond as well. If the market price is higher than par value, which it is here, okay, then the bonds are said to be trading at a premium. Okay? Remember, when the discount rate falls, discount rate went down, the bond price goes up. All right, let's look at some important bond relationships. The relationship between changes in market interest rates and bond prices, which are market values. As interest rates rise, bond values or prices fall. As rates fall, bond values rise. Okay? There's that seesaw that we finance professors have been using for many, many years, the seesaw. Interest rates move up and down. This is the independent variable, and this is the dependent variable. Interest rates go down, bond prices go up. Interest rates go up, and bond prices go down. An inverse or negative relationship. All right. Let's look at the relationship between the coupon rate on a bond, the market rate out there in the market, the par value, and the market price. Okay? How are these things related? Well, when a bond's coupon rate equals the market rate, which is what happens when a bond is first issued, the coupon rate is set based on the market rate, so they're the same when a bond is issued. Then the bond's price equals par value. When a bond's coupon rate is greater than the market rate, not because the coupon rate has gone up, but because the market rate has gone down. Remember, the coupon rate doesn't change, but the market rate does. Okay? The bond's price will be higher than par value. The bond's trading at a premium. Anytime a bond is trading at a premium, it means the market rate has gone down and is below the coupon rate. Okay? When a bond's coupon rate is below the market rate, it doesn't mean the coupon rate's gone down, it means the market rate has gone up. And you know what happens when the market rate goes up? The bond price goes down, and the bond is trading at a discount. If the market rate goes up above the coupon rate, the bond will be trading at a discount. Anytime a bond is trading for less than $1,000, the market rate has gone up since the bond was issued. Okay? Then lastly, okay, for a given change in interest rates, the value of a long-term bond is more dramatically affected than the value of a short-term bond. Okay? This is the basis for what we call maturity or interest rate risk, okay? So let me go back to that for just a second. So if you think that interest rates are going to go up, then you think that bond prices are going to go down. And you don't want to own a long-term bond. You'd rather own a short-term bond because your bond price for a short-term bond will go down by less than the bond price for a long-term bond. On the flip side, if you think interest rates are going to go down, then you think that bond prices will go up. And you want to own long-term bonds because your long-term bond, the price on your long-term bond, will go up by more than the price on a short-term bond. So if you want to trade bonds, you have to pay attention to what you think will happen with interest rates. Okay? So just know that the price of a long-term bond is much more sensitive and will change more than the price of a short-term bond in reaction to or response to changes in interest rates. All right, that's it for this clip. We'll see you on the next clip. Shalom.